we're looking here at swaps, forwards and futures. This will be for interest rates, for currencies, even volatility as an underlying asset and equity markets. The key thing to keep in mind at level 3, as we keep saying, is it's very applied. So we're not going to be going through the torture of pricing and valuing like you've seen at previous levels. We're going to be thinking, what sort of swap is relevant in this situation? How much of it should we use? How do we get a certain result? How do we get a solution to a particular case study that is in front of us in the exam? So let's start off with interest rate-based products. The £800 gorilla in the room there is, of course, your plain vanilla interest rate swaps, which we've met at previous levels. Let's just remind ourselves how they work. Interest rate swaps, and any swap really, but interest rate swaps are an agreement to swap two legs of cash flows periodically going into the future. Interest rate swaps will have legs that are linked to some form of interest rate. The most plain vanilla contract will have a fixed leg that obviously is fixed and doesn't change, and a floating leg that is being paid in return. The payments tend to be netted off, and the major use of these interest rate swaps, as the slide is saying here, is to either hedge interest rate exposure or to convert into interest rate exposure from fixed to floating. But the contract itself, I always like to picture the contract itself as being between two counterparties. How I always imagine swaps, I always find it useful to picture what's going on. Maybe A is paying over a fixed leg, known at the outset, and B is paying over a floating leg. Historically, that's been linked to LIBOR, which is reset on a periodic basis. So these payments tend to be netted off. You'd refer to A as the payer, or the pay fixed side. You'd refer to party B as the receiver, or the receive fixed side. And these payments would be netted off. If the fixed leg is 4% and the floating leg for a particular period is 5%, then actually 1% would be transferred, would be paid from party B to party A for that particular period. Obviously the floating leg changes each period. And of course 1% is de-annualized for the period in question. So it might be a 6-monthly period. So it's got to be divided by 2 essentially to apply it for 6 months. And don't forget then it's applied to a notional principal, which is the size of the contract. That doesn't change hands, but is a notional amount of money that is referred to when we're calculating these interest rate related payments. So let's go back to the slide. The slide will be catching up with us here with regards to this basic definition. Payer paying fixed rate payments, that was party A in my swap. The other side is referred to as a receiver, that was party B in my diagram, okay? And yes, obviously they are the flip side to each other. The other side to a payer is a receiver. Now, here's a crucial thing with swaps. You'll have realized this at previous levels, but let's just re-emphasize it. Let's reinforce it here. That floating rate payment, whilst it changes every period, it's actually known at the outset of the period and then paid in arrears, paid at the end of the period. Why is that? Well, this floating rate, which historically has been linked to the London interbank offered rate, which is the unsecured short-term interbank borrowing rate in London for different currencies, different maturities. That LIBOR rate, if you think about the underlying market, the underlying money market, banks will agree what rate they're going to borrow at, then they'll go ahead and borrow and then pay it back, the loan and interest at the end of the period. So this is something that's crucial for interest rate derivatives that are based on money market rates like LIBOR. Rates in any particular period, like you might have this periodicity here, each one of these might be sort of 6 months or a quarter or whatever, but you've got period 1, 2, 3 and 4. We know the rate at time 0, maybe LIBOR naught. We know that at time 0, but that is used to settle up, if you like, paid at time 1. LIBOR at time 1 is known at the start of the second period. All right, it relates to the second period. LIBOR at time 1, it is paid, used to settle at time 2, and so on. So just be careful with that. When a floating leg is actually paid, it's actually the floating leg which was set at the start of the period that you're currently in, that you're at the end of. All right, So actually that means that first LIBOR that's paid at time 1 is known up front at contract initiation, isn't it? You can see that here. We actually know what 6-month LIBOR, say, is at time 0 now, but we know that it won't be used to pay out until the end of the period, in other words, after 6 months. Okay, but the floating rate is always paid in arrears. That's the key thing. So I quite like this way of visualising a swap using boxes because it helps to really give the big picture as to which direction currency or cash flows are being made. And it often helps visualise what an investor would need to do if they had a certain view and a certain exposure to interest rates. So there's a big table here, a relatively big table of 4 different positions that you could have. Really, rather than trying to learn this table, what you should do is think, given an exposure, how do I move that exposure? How do I remove that exposure using a swap? And the key for me to doing that would be to picture it, to use a picture like this. So what do I mean by that? Well, you might very well find yourself faced with an investor and they've got some sort of underlying exposure or existing exposure to interest rates. So that would be through a borrowing where they're paying fixed or floating, or an asset where they're receiving fixed or floating. We could just pick a random one. Let's pick, or just pick one at random. Let's pick the third one. Let's say they've got a floating rate asset. So I would draw that this investor's got a floating rate asset, an FRN if you like, a floating rate note. We don't necessarily know what that's paying, that floating rate note, but we do know that that's a floating leg coming in. You'll notice that all my floating legs are kind of wiggly, right? They move around, whereas fixed legs are straight arrows. So how does the investor get that? This is a floating asset, floating rate asset, paying a floating income to the investor. It's moving up and down in line with LIBOR. How do they get rid of that wiggly arrow, that floating rate coming in? Well, they would pay a floating leg going out, wouldn't they? So they'd pay floating out to a swap dealer or a counterparty, and in return they'd get fixed back. So that would be your recommendation in a question. This investor should pay away that floating income. So pay floating, they should be a receiver in this swap. They should receive fixed. And that will, if this FRN is bringing in LIBOR plus 0.5%, say, and they pay away LIBOR and they receive in a fixed of 3, then the net exposure of this investor is going to be an income. This is in terms of income. They've got LIBOR plus 0.5 coming in under the bond. LIBOR is being paid away under the swap, and they've got a fixed leg of 3 coming in under the swap. So add those up. It's the floating legs that cancel out as we originally desired, and we're left with a synthetic fixed asset. And the asset plus the swap is a synthetic fixed coupon bond paying 3.5%. So really that's the fishing rod that you can use to go and fish now. You can get any of these 4 different scenarios out by thinking about the investor's point of view, what their exposure is, and really offsetting that exposure by passing that exposure on to the swap dealer. We'll do another one quickly just to make sure we're okay with this. Oh, by the way, yeah, we do need to be concerned about this exposure in order to want to remove that exposure. So, if you've got floating income coming in, you'd be worried about rates falling, and that's why you'd enter into this receive fixed swap. Let's pick another potential situation where we want to hedge. Let's pick a liability. Let's change it to a fixed liability, so a fixed rate liability. Once again, draw the boxes to get the big picture here. A fixed liability. So you've got an investor or a client, you've got some sort of market participant here, and they have got a bond, so a fixed coupon bond, that they have issued. So they are paying out fixed on that, all right? Maybe they're paying out 6% on a fixed coupon bond. That's part of their financing as a company. If they don't like that fixed leg going out, now why wouldn't they like that fixed leg going out? Well, it might be because they expect rates to fall and 6% becomes a very high coupon in that lower rate environment. So very similarly here with a fixed rate liability, we might be worried that rates are going to fall. Notice that that's exactly the same concern as the previous investor that had a floating asset. And that leads us to have exactly the same trade with the swap dealer, because we don't want this fixed going out anymore. So we get fixed coming in. So we are a receiver again, and out goes the floating. I won't put numbers into this one, but once again, it was all about just drawing the boxes, seeing the picture. And to be honest, this doesn't go way beyond the sort of things that you were doing at level 1 and level 2 when it comes to the basic uses of swaps. Okay, so moving on here. What else are we going to do? What's the real new level 3 stuff here? Well, look, here's an example, just to really hammer this home. Maybe you can work through this with me. ABC Inc. issued a $30 million semi-annual pay 4-year floating rate FRN with a coupon of 180-day LIBOR plus 25 bips. Okay, so that's a very long-winded way of saying that they've got a floating liability. All right. So if they've got a floating liability, you can imagine ABC. Well, floating liability, it's neither of those, is it? This company, ABC, has actually got a floating arrow going out on their debt. And so for the swap to remove that, they'd want a floating arrow coming in, and they'd want a fixed arrow going out. So it's the other way round here to what we've seen before. This is going to be, ABC would be a payer of the fixed leg with the swap counterparty. And I think we're going to get some numbers with this one where we could actually work out what their net exposure is, because their debt, which is an FRN again, that is paying, or at least they are paying on that, LIBOR plus 25 bips. So LIBOR plus 0.25%. We will be told in the question what the swap market is offering for the relevant swap. And we do need to want to remove this exposure. With a floating borrowing, you'd be worried about LIBOR rising, interest rates rising. So with that, you're going to enter into, yep, there it is, a 3-year payer swap. That's what we deduced by looking at the arrows, the direction of the arrows. 2% fixed is the fixed leg, so that's 2%. And what we get back on the floating side is assumed to be LIBOR by default. So now the net exposure, hopefully you can see LIBOR going out under the bond, coming in under the swap. So you're just paying out fixed 2% plus the margin over LIBOR of 1/4. So you've synthesized here essentially 2.25% fixed rate debt. But let's see that in action. I'll just make that point off slide here. We have synthesized. What have we done? We're still paying LIBOR plus 0.25, but we're receiving LIBOR in. This is our cost of funds. We're receiving LIBOR in under the swap, and we're paying away to. So yes, 2.25%. This is our synthetic cost of funds. We've synthesized a fixed borrowing here. And by the way, we can kind of work out what that means our net payment is going to be each period when we consider the bond and the swap. This means our net payment out when we consider all cash flows is going to be the size of the borrowing, which you might remember, the size of everything is 30 million here, multiplied by the 2.25%, net cost of funds, considering all the positions together. Now don't forget, this is a quarterly swap. All right, apologies. This is a semi-annual swap for 4 years. Apologies. All right, this is a semi-annual swap. So all of the rates are quoted annually, but this is paid semi-annually. So you are going to have to multiply by 180 days out of 360. So I'm assuming it's a 360 day count here, just for simplification purposes. And I would make that assumption, simplifying assumption, unless you're told there's a specific day count in the question. But there usually isn't. So that's a nice simplification. When we calculate 30 million times 0.0225 and we multiply that by 1/2, I make that number 337,500. What we're going to see is no matter what LIBOR does, we're going to end up paying 337,500, and that is essentially our overall cost of funds when we consider both positions. All right, but in more detail, let's say at swap initiation, 180-day LIBOR was 1.5%. So that's like your L0. Right now, that will be used for the floating leg at the end of the first period. That means at settlement date 1, time 1 if you like, 180 days after the swap initiation, the fixed payment under the swap is notional principal times 2%, that's the fixed leg, and then de-annualized, so that's 300,000, okay? That's going out. The floating payment coming back in is L0, LIBOR at the start of the period, 1.5%, multiply that by the notional principal and de-annualize, that's 225. So the net cash flow under the swap is 300 out, 225 back in, that's 75,000 out. That's the net cash flow under the swap. Don't forget the loan will pay 30 million multiplied by 1.5, that's the LIBOR that's relevant, plus the margin that you're paying on your debt, de-annualize. Don't forget to de-annualize these rates, else, you know, you're going to run into problems. So that's 262,500. So overall, what are you paying? It's the number we first thought of. 262,500 actually on your debt, which is nice and low because LIBOR looks relatively low here compared to other rates, but that does mean that you're losing under the swap. So you have to pay more out under the swap. This is your total payment. And yes, it gets us back to that number we first thought of, which we knew is 2.25%, essentially de-annualized. A bit of overkill here, but at settlement date 1, we observe a LIBOR at time 1 of 3%, so that's increased quite a lot, and that's going to be used to settle up at the end of the period to which it relates, in other words, time 2, 360 days after swap initiation. Now the fixed leg, being the fixed leg, remains fixed, doesn't change. The floating leg, well, we just say, look, the relevant rate here now is 3%, so that's the only thing that changes, and actually that means we get a payment in under the swap, because in comes the floating payment of 450, and out goes that fixed payment of 300,000. Don't forget we are a payer of the fixed leg here. Now, unfortunately, given that we're getting a payment under the swap, that must mean that rates have gone up and we must be losing under the loan. So here's the FRN payment, $30 million. LIBOR, the relevant LIBOR for this second period is the LIBOR at time 1, the start of the period, plus the margin, de-annualized, 180 over 360, that is 487,500. So we are paying a lot more for our loan in this second period. Well, the net payment that we're making is the 487,500 minus the profits we're making in this period under the swap, and yes, it gets us back to that number we first thought of. So yes, a real kind of sledgehammer to crack that particular nut with regards to demonstrating that our overall cost of funds is 2.25%. All right, moving on. Something that has been of great interest to the examiner over the years is changing your portfolio exposure. This is a key area, a key application of these derivatives, changing your exposure to key risk factors using derivatives. So the key risk factor in interest rates, of course, is duration. The most useful form of duration is modified duration. Modified duration is your percentage change in price or value for a 1% change in yields across the curve, a parallel shift in 1% yields. That's what modified duration is. And one of the things that we're going to do with swaps is we're going to target a modified duration. All right, I'll move away from this example now. We're going to target a modified duration. Okay, so duration, of course, is your sensitivity to interest rates. And in order to assess a swap's impact on your duration, we're going to need to know how to calculate the duration of a swap. So in order to do this, we're going to use a little trick that we did at level 2. We're going to view a swap as a combination of two bonds. Now we did this at level 2 when we were valuing a swap. It's a very simple idea. Whatever you are receiving, you are long that bond. Whatever you're paying, you are short that bond. So A over this side, the pay fixed side, well, if they're paying fixed, I'm going to imagine that they have sold a fixed coupon bond. all right? And if they're receiving floating, I can imagine that they have bought an FRN, all right? Whatever you're receiving is like you've bought a bond paying that coupon, and whatever you're paying, A is paying fixed, it's like you've sold a bond that's paying that coupon. On the other side, party B here that's receiving fixed, I can imagine that they have actually bought a fixed coupon bond, like a normal fixed income bond, and they have essentially sold, because they're paying out the floating rate, all right, they've sold an FRN to fund their investment in a fixed coupon bond. Now here's a key idea. When it comes to duration, a fixed coupon bond, you can kind of picture it as average time. You know, I know we need to modify duration for it to be useful, but a fixed coupon bond has got an average time which is very close to the maturity of the bond, which in this case would be the life of the swap. All right, it's quite long. It's going to be certainly long versus the duration. It's going to be longer than the duration of an FRN. The duration of an FRN is going to be very low. Why? Well, because an FRN, a floating rate note, when interest rates go up, its coupon payments go up. So technically, if it always adjusts immediately when rates go up, you get bigger payments that you discount at higher rates, it should always trade at or close to par. So its sensitivity to changes in rates is very low. It's the fixed coupon bond that's got a very high sensitivity to changes in rates because its coupon is fixed. Okay, so this is the idea. The fixed side has got a big duration. The floating side has got a small duration. And when you think of these two participants, A and B here in this swap, you can now see that B is bringing on board duration by receiving a fixed income. And that's like day one, level one fixed income comment, isn't it? When you buy a fixed income asset, your duration goes up. So B here is increasing their duration because the duration that's coming in on their fixed coupon bond is going to be bigger than the duration that essentially they are paying away under the floating leg. A here is actually lowering their duration. Why? Because they're paying away the fixed leg, and away with that fixed leg goes exposure to fixed income. So down goes their duration, and in comes a floating rate note exposure, which is a small duration. All right. So big picture, it's the fixed leg that brings duration with it. If you receive fixed, duration will go up. If you pay away fixed, duration will go down. Okay, that's the big picture. And the slides are going to be agreeing with us here. The receiver of what? Receiver of the fixed side. Well, that's like they're issuing a floating rate note and buying a fixed coupon instrument, a fixed rate note. Given that the fixed rate duration is going to be bigger, I call it big D, it's going to be bigger than the floating rate duration, call it little d, the receiver side is going to be increasing their duration. Yeah? They're going to be adding positive duration through their receive fixed swap. The payer side, which in my diagram here was party A, paying away fixed, they're going to be paying away more duration than they're bringing in under the floating rate note, so they're actually going to have a negative duration through the swap, and they're going to be lowering their overall duration by entering into this pay fixed swap, this payer swap. So yeah, don't forget what duration tells you. Duration tells you your sensitivity to changes in rates, and it's an inverse relationship, isn't it? Usually, when you've got positive duration, it means that prices go down when rates go up. So if you've got a negative duration, it's not a negative relationship anymore. It means it's a direct relationship. In other words, with negative duration, you win when rates go up, you lose when rates go down. Now that, don't forget the payer is here. We knew that already. What I just said, so the payer is here, party A, we knew that already. They have got negative duration. They win when rates go up because the floating side goes up and the fixed leg stays fixed. They lose when rates go down. We knew that already, but it's just, almost a distraction technique to call that negative duration. It's just trying to sort of scare people away. Right? It just means there's a direct relationship between rates and profitability. Of course, the receiver has positive duration, as we've said, and that means when rates go up, they lose out, right? You know, when B with their positive duration, because they're bringing in big D on the fixed side and only paying away small d on the floating side, with their positive duration, they lose when rates go up, which makes sense, doesn't it? Because they have to pay more when rates go up, and their fixed side is not so valuable. Okay, so more generally, folks, and it is something that the examiner has focused on over the years. There's no reason why they couldn't give you the duration of the fixed side and the duration of the floating side. More generally, the modified duration of a swap, modified duration is the useful version of duration, isn't it? It's telling you your actual estimated percentage change in value per 1% change in rates. The modified duration of a swap, you can just think of it as the modified duration of what's coming in minus the modified duration of what is being paid out under this analysis. That's the general idea. So, for example, if we are told that this big duration here of the fixed side is, say, 5, and this small duration here on the floating side is, say, 0.25 for party B, okay, the received fixed side of the swap, then it is as simple as to say, well, the modified duration of the swap would be 5 minus 0.25, which is 4.75. And once you've got that modified duration of the swap, you can use it. You can use it to to determine what the size of a swap should be when you're trying to achieve a certain target duration in your portfolio. So a little formula comes up here. This is a very important formula, all right? Very important formula for the exam. It's a very basic formula as well. Given that we now know what the modified duration of the swap is, you can get it from this basic relationship, or you'll be told it in the question. You can just say the size of the swap that I need to take to fulfill my objectives is simply going to be driven by how much duration I want to change. So this is your existing portfolio duration. It's all modified duration, that's why they call it MD. All right, so you've got your existing modified duration of the portfolio. You'll have some sort of target duration here. All right, so on the top of this fraction here, you've got the change in duration that you desire. Target minus current portfolio. On the bottom, you've got the modified duration of a swap. That'll be the modified duration of what's coming in minus the modified duration of what's going out, as we just discussed. And then all you need to do is just scale that up by the size of the portfolio. So if you like, this term in the brackets here is telling you what change in sensitivity, it's dealing with sensitivity. It's looking for the change that you're after relative to the change that one swap brings, all right? And then you're scaling up for the size of the portfolio. Okay, very important equation. It's kind of like on the real top of the hit list for your exam, okay? Let's make sure we can use it. So here's a scenario where we've got a fund manager with a portfolio of 120 million, that's VP, and it's fixed rate UK bonds, okay, so fixed coming in. They think interest rates will fall, which is good, isn't it, if you've got fixed income, but you might want to extend your duration if you think rates are going to fall, so that prices go up by more. The manager, there you go, wants to increase duration from 4.5, that's the modified duration of the current portfolio, to 6, that's your target modified duration. A payer swap is available. Let's just remove that scribbling so we can read it. A payer swap is available with a duration of -2. Don't forget, paying away the fixed leg is paying away duration. So we're not really interested in a swap with negative duration. We're more interested in a swap with positive duration because we want to increase our duration. So we're going to receive fixed and bring more duration into the portfolio. Now that's the modified duration of the swap. You're being told that here. So there's all of your ingredients. You know the recipe. You can go away here and bake your swap cake, can't you? As long as you know the formulae, as long as you know the recipe, the notional principle is required, the notional principal required is value of the portfolio multiplied by target duration, technically it's modified duration, minus current portfolio duration relative to the modified duration of the swap. So here we've got 6 minus 4.5, that's 1.5. We're dividing that by 2, so that is 1.5 over 2, that's 3/4. Okay, and then we're multiplying that by 120 million, and reassuringly that comes out at 90 million. Now that's a very common exam question, so make sure that you can do that little calculation there. And now on to forward rate agreements. An old friend of ours, we've met FRAs, level 1 and level 2. They get a mention here at level 3, and we should be aware of how to apply them. Now, FRAs in many ways are like a single period swap. They relate to a period in the future, say like 2 or 3 months' time, where there is going to be a need to either borrow or deposit funds. Now, you can enter into a FRA today that has a fixed rate associated with it, which obviously doesn't move. And when we get to that future borrowing period or the relevant period that underlies the FRA, if rates have gone up above the fixed leg, the long FRA wins, and obviously the short FRA loses, and vice versa. So remember, long FRA, long rates. And the best way to think about a FRA is really to think in terms of a timeline. There is just one period in the future to which the FRA relates. We're standing here now. There might be, say, 60 days or something until the FRA expires. But when the FRA expires, it's very important to realise that we're standing at the start of the relevant period which underlies the FRA. So it might be the case that all of this FRA was based upon a 120-day period, which starts in 60 days' time. Okay? So the idea is we can agree a FRA rate today. We agree that FRA fixed rate today. That relates to this period. If you like, that's our expectations, or that's what's priced into the yield curve at time 0 as to what the 120-day rate will be when we get to the start of the relevant period, or the borrowing period, as it's sometimes called. But the idea is this. If we go long the FRA and rates go up over the next 60 days, then we win here when the FRA expires. All right? If you're long. All right? You would obviously lose if you're long and rates go down. So the long wins at the FRA expiry here if LIBOR at day 60 turns out to be bigger than the fixed FRA rate that we locked in essentially at the start, sometimes referred to as the FRA price. So that's the general idea. Just a little bit more terminology here. This particular FRA that I'm looking at, where the borrowing period starts in 2 months' time, so that would be 2 months in kind of money market language, 30 days a month. So when the relevant period starts in 2 months and ends in, well, it ends in a total of 180 days, doesn't it, which is 6 months. We might refer to this as a 2x6 FRA. That's telling you when the borrowing period begins and when it ends. It begins at time 2 and it ends at time 6. So that's the basic setup for a FRA. The slides are going to follow us with this example actually. Consider a FRA which expires and settles in 60 days. That ties in with our example here. And the underlying rate is a 120-day borrowing rate. So the relevant period here is a period that starts in 60 days' time and goes on for 120 days. This, of course, is a 2x6 FRA. If you go long, you win if 120-day LIBOR is higher than the original FRA fixed rate in 60 days' time. So, yeah, each number here is a number of months, which are assumed to have 30 days. Okay, so 60 days the FRA expires. That's 2 lots of 30. And yes, 6 minus 2 is 4 times 30. That's 120 days in the borrowing period. That's the kind of the algebra there. Now, the payoff of the FRA, it's very important that you realise that the payoff of the FRA relates to a payment in the underlying loan market, which would happen here. This is where a loan payment would be made. So this is the period to which the payoff of a FRA relates. If the FRA wants to pay out the start of the relevant period, it's going to have to discount its payoff back to the start of the period, otherwise it would be paying out too much. You know, the fact that the loan payment happens at the end of the loan period, the borrowing period, that means that's where the FRA payoff is relevant to. The end of the borrowing period. But if it actually pays out at the start of the period, that's why that means we've got to discount the FRA payoff back to the start of the borrowing period. Okay, so I think, yes, the graphic that's on the slide is going to give its own version of what we've just said. This 2x6 FRA, is really relating to a borrowing period or lending period, which starts in 60 days, that's 2 lots of 30 days, and goes on till 180 days. That's another 120 days. The payoff of the FRA, which is what LIBOR turns out to be at time 60 over the original fixed rate, which is known at the outset, all right, the FRA fixed rate known at the outset, de-annualized for the number of days in the period, out of 360 days, scaled up by the notional principal. That is the payoff of the FRA, and it is relevant to the end of the borrowing period. The fact that this payoff is made at the start of the borrowing period means, to respect the time value of money, it must be discounted back at whatever LIBOR evolves to be for the period. Okay? So let's have a look at an example to really enforce this idea. So Smithies wants to borrow £1 million for 180 days, 90 days from now, at LIBOR plus 50 bips. So it's this that's uncertain. We don't know what LIBOR is going to be in 90 days' time. If they're worried that interest rates will rise, and when we pick up the phone to the bank in 90 days' time, and they say that LIBOR is something extortionate, what we might want to do to take the edge off of that is go long a FRA. Obviously, the FRA is going to expire 90 days from now. That's 3 months from now. And we want the relevant loan period to be 180 days. That's 6 months. 6 months in the, or 180 days in the borrowing period. So this is a 3x9 FRA, and the fixed rate, we're told, is 5% when we enter the FRA at time 0. If rates evolve to be higher than 5%, then the long FRA will get paid, all right, and that payment, that payoff, will compensate essentially Smithies here for the extra cost of borrowing that they're going to have to pay for their loan. It might be worth just thinking about what we've locked in. You know, whatever LIBOR evolves to be in 90 days' time, under the loan, we're going to pay LIBOR plus 50 bips, 0.5%. The FRA will pay us whatever LIBOR evolves to be minus 5%. And that could be negative, of course, because if LIBOR goes down, we're going to pay out under the FRA. So net, what have we got here? We've got LIBOR plus 5 being paid. Yeah, we've got to get our signs right here. Okay, so if you think about it, we are paying LIBOR plus 0.5% out on the loan. With the FRA, this is our payoff, so this is going to come in. So if you like, our net payment out is going to be LIBOR plus 0.5 on the loan minus LIBOR minus 5 payoff on the FRA. And so if we just do a little bit of algebra there, the LIBORs which are uncertain, they cancel out, and we end up with 0.5% plus 5, which is 5.5%. So no matter what happens, we have locked in a 5.5% cost of funds on our loan, no matter what happens, whether rates go up or down. It might be worth just actually thinking what that is in dollars, because we're going to see this number quite a lot. 5.5% or for how many days in the loan period? There's 90 days in the loan period. There's 180 days in the loan period. Apologies. 180 days in the loan period multiplied by the notional principal of $1 million. All right. That comes out, that's 5.5%. Half that, that's like 2.75%. Multiply that by $1 million, and we're looking at 27,500 quid. That's definitely what we're going to be paying when we consider our loan plus the FRA. Well, let's see if the numbers agree with that. If LIBOR evolves to be 7, then LIBOR's gone up. That's good news from a FRA perspective, but bad news from a loan perspective. We pay LIBOR plus a half, de-annualised on $1 million on the loan, but our FRA pays off to the tune of 2%. So LIBOR's evolved to be 7 over the FRA fixed rate of 5, de-annualised, multiplied by $1 million. That is a receipt of 10,000. Net, we see a familiar number, 27,500. We knew that's what our net cost of funds was going to be. Okay. Similarly, it's no surprise that, well look, this net cost, by the way, is ignoring the discounting of the FRA payoff back to the start of the period. That's an important point to make that's being made by the final bullet point on the slide there. If you actually wanted to look at what the FRA was paying off, then you'd have to discount this £10,000 back from the end of the borrowing period to the start of the borrowing period for 180 days at that rate of 7%. So the FRA would actually pay out slightly less than 10,000 at the start of the borrowing period. If LIBOR turned out to go down prior to expiry, prior to 90 days' time, then the good news is the loan will be cheaper. All right, 3% plus your margin of 0.5%, de-annualised, multiplied by $1 million. However, the FRA is going to be losing, and actually you're losing 10,000 here because you're the same distance below 5 as you were above 5 when LIBOR evolved to be 7. So your net cost of funds here, your total cost of funds, is again the number that we first thought of. That loss on the FRA is increasing your cost of funds. And yes, 27,500 is an unsurprising conclusion to come to. Now, because we knew it was going to be that. But don't forget actually that the FRA receipt, that's the kind of the amount that we can imagine happening at the end of the period. That would actually, in reality, be discounted back to the start of the period, start of the borrowing period. Okay, now FRAs are historically OTC instruments, over-the-counter instruments. They're not exchange traded. So they're not standardised massively. They're not traded on an exchange. They're not centrally cleared. At least that's not been the case historically. Historically, there has been a futures exchange traded sibling or cousin of the FRA, and that's referred to as the short-term interest rate contract, or the STIR. So this is exchange traded, listed on exchanges like CME, ICE in Europe. Very similar concept to FRAs in that it relates to a short-term borrowing period in the future, but the way it's priced is very different, and the way it's therefore you trade it is very different. I mean, being exchange traded, it is a standardized contract. Okay, there are only specific maturities. You're going to be margined by the clearinghouse that is working with the exchange and mark to market every day, so you have to pay losses essentially as you go. The other thing is the details of the contract are specified and set by the exchange. It's not negotiable. So in the States, it's probably it's probably of interest. I'm sure they wouldn't expect you to remember this stuff in the exam. They'll give you details. But in the States, a STIR, short-term interest rate contract, it's on interbank rates like LIBOR. All right, so it might be on dollar LIBOR. The size of it is $1 million loan. That's the notional principal of the contract. And the borrowing period is 3 months, okay, or 90 days. That is the standardized size of the STIR in the States. And what exchanges will also do is they'll specify what the minimum price movement is in the price of the contract. That's what's called a tick. And they specify that 1 tick here is 1 basis point. So the contract cannot move. The contract will be priced with a certain percentage priced into it. It can't move by a fraction of a basis point. A basis point is the minimum movement that the contract can make in terms of price. I mean, it can move by more than 1 tick. It can move by 5 basis points and so on, but it can't move by less than a basis point. Basis point, of course, is 1/100%. This means there is a tick value that's associated with this contract. The tick value is a 1 basis point move. So let's just re-emphasize what a basis point is. It's 1/100th of a percent. It's 0.01%. Now be careful. That's a percentage, and we know we need to turn percentages into decimals when we do calculations by dividing by 100. Just in the same way you turn 1% into a decimal by dividing by 100 and getting 0.01, you need to turn 0.01%, that's a basis point, into a decimal by dividing by 100. So the impact of a 1 tick move in dollars is going to be the decimalized version of a basis point. So that's 0.01% divided by 100, multiplied by 3 months out of 12. It's only a 3-month contract. All right, the borrowing period is only 3 months. All rates are quoted, stated annually, but this is only a 3-month contract, and there is $1 million loan deemed to be relevant here. Now, if you do that calculation, we're looking here at 1 basis point. We're looking at a quarter of that, and we're scaling it up by $1 million. What we get here should be $25. And that's what we get. So $25, that's the economic impact of a 1 tick move. That's what a tick value is. It's the economic impact of a 1 tick move, a 1 basis point move. So every time the interest rate priced into a stir moves by 1 basis point, $25 is made by the long or lost by the short, depending on which way interest rates have moved. What's very important with regards to these stirs, which by the way are often referred to as euro-dollar futures, all right, because they're the main contract, on LIBOR. What's very important, dollar LIBOR, what's very important is the way that their price is quoted. They're quoted according to what's called the International Money Market Index approach, and that is they're quoted as 100 minus the annualized forward rate priced into the contract. Now, this means if we're dealing with a certain maturity, and there's a 3-month period in the future that starts at the expiry of the stir, okay? So the stir expires here, just like the FRA expires there. If yield curves suggested yield curves demonstrated that the relevant 3-month rate, I don't know, let's say the stir expires in 1 month time, for example. If the relevant forward rate for this period, that's the 3-month period starting in 1 month's time, if the relevant forward rate was say 3%, this means the stir price right now will be 100 minus 3, which is 97. Okay? That is how this contract is priced. It's called the International Money Market pricing mechanism. So why do they do it like this? They do it because if expectations of rates go up, if forward rates go up, the stir price will go down. If rates go up, the stir price will go down. And this preserves the inverse price rate or yield relationship of fixed income. We're used to, in fixed income and money markets with securities, we're used to when rates go up, the price of instruments go down. And the stir respects that through this pricing mechanism that it uses. Okay? Now most of these contracts are closed prior to delivery, like most futures contracts. The underlying reading just makes the point that most contracts are offset and closed prior to delivery. All right? And these forward rates that go into a stir's price, they're just really they're the forward rates that are baked into LIBOR yield curves. They're the forward rates we backed out at level 1. They're the forward rates that go into the fixed rate on a FRA. We know what these are. These are our old friends. It's just the way it's quoted that's different. If a forward rate for the relevant period is 3%, we don't quote the stir at 3%. We quote the stir at 100 minus 3, which is 97. And the profound impact of that is that we get an inverse price rate relationship. So just be very careful with that, because if you think rates are going to fall, all right, then you would buy stirs because stir prices would rise as rates fell. But that's the opposite of a FRA, isn't it? A FRA wins when rates go up, but a stir wins when rates go down. So be very careful with that. Let's have a look at an example here. Alain Luard expects to receive a $20 million inheritance in 120 days. So as soon as we find out that Luard wants to invest the 20 million at some sort of floating rate, then we have interest rate risk that LIBOR turns out to be not very big. All right, and yes, incidentally, we just point towards that. We're worried that in 120 days' time, LIBOR is not very big, and we're worried, therefore, about interest rates falling. So, if you're worried about interest rates falling, you'd sell a FRA, but with a STIR, you would buy it, because if interest rates fell, the STIR price would go up. Now, the size you need to take here, don't forget there's $1 million underlying each STIR. That's the size of one contract. Okay, so take that $20 million exposure that you need to hedge, divide through by $1 million exposure for each contract, and you'll get 20 euro-dollar futures contracts that you need to go long, expiring in 120 days. That's when we start their lending period in this case, and they're trading at 95. This means the forward rate that's priced into those contracts is 5, isn't it? Because 95 is 100 minus the forward rate. So calculate his return if in 120 days LIBOR turns out to be 3.5, or if it turns out to be 6.5. You might wonder why there isn't like a number of days in the rate kind of calculation here, and the reason for that is, of course, that's standardized, isn't it? It's a 3-month borrowing period, 90 days in the future period, so that's all standardized by the exchange. So that goes without saying, because we know it. The big picture here, the big picture is that this, by buying this FRA at 95, we're really locking in a deposit rate of 5%, okay, minus the spread. So we are actually locking in an income, an interest income of 4.75% on our 20 million. That's what we're locking in overall. So what's locked in here? Locked in is 5%, because we get paid if rates go below that, so we're hedged against it. 5% minus our margin, that's 25 bips, okay. So that's 0.0475, and then don't forget it's only for 3 months. These rates are all annual, but they need to be de-annualized, and that's on $20 million. So this here should be the income that we've locked in, no matter what LIBOR evolves to be. You can see some kind of scenarios here as to what LIBOR is evolving to be. We know that when we do our calculations here, we're actually locking in 4.75% divided by 4, essentially 3/12 times 20 million. And that turns out to be 237,500. That's going to be a number that's going to feature a lot in the coming calculations. Let's have a look. If LIBOR goes down to 3.5, now the interest on the deposit, so we do make the deposit at 3.5 minus 0.25%, de-annualize it, multiply by the amount, the size, and that's, don't forget 90 days in the period is the relevant time here, because that's standardized by the STIR. So 162.50 is what we get on our deposit. That's not very much, but we are getting paid on our STIR, because our STIR ends up priced at 100 minus whatever LIBOR evolves to be, which is 3.5. So the STIR ends up at 96.5 in terms of pricing. So we've made here 150 basis points, haven't we? If we essentially sold rates by buying the STIR at 5% and LIBOR evolved to be 3.5, we've made 150 basis points. Each basis point is worth $25, and we got involved in 20 contracts. So scale that up, we'll find profit here of $75,000. Yeah, don't forget the tick value that we derived earlier. Each basis point is worth $25, and we did get involved in 20 contracts earlier on. So that's our P&L from the STIR. So our total income, if you like, is 162 from the deposit, 75 profits from the STIR, and there it is. That's the number we first thought of. Almost trivially, if LIBOR goes up, we're going to find, yes, we get more interest on our deposit. I'll let you check those numbers. We're going to find ourselves losing on the STIRs though, aren't we? Because 100 minus 6.5 is lower than where we bought the stir. We bought the stir at 95. So we've lost on the futures here. It's symmetrical. We've lost 150 basis points, so we've lost 75,000. But don't forget, we got more interest on the deposit because of LIBOR going up. And yes, you've guessed it, 312, 500, minus the 75 loss on the stir gets us to 237,500, the number, once again, that we knew was our ultimate destination. Okay, so we've looked at FRAs and we've looked at stirs. These are two contracts which allow us to hedge or take exposure or change our exposure to shorter term interest rates over a matter of months. Let's turn our attention to contracts that look out for a longer time period. So we're going to be turning here to Treasury bond futures contracts that give us exposure to interest rates over multiple years, not just a few months over the next couple of years, but we're turning towards longer maturity instruments that give us exposure over multiple years. And we're really thinking here, as we move towards these fixed income futures, we're really thinking here about our exposure to duration, the classic fixed income risk factor. So we would alter our duration or hedge our duration, typically using bond futures, Treasury futures. Now, being level 3, we're not meeting anything new here. We have met these fixed income futures, these Treasury futures, which is the kind of the default instrument here. We've met them before. We've met them briefly at level 1, and we've done a forensic analysis of their pricing and valuation at level 2. Now, just like most things at level 3, it's less about the technical and more about the application. So you've really got to focus here on how you use these contracts to achieve a certain outcome with regards to duration, the major risk factor. Just as a reminder, of course, I'm talking about duration like, you're completely comfortable with what it is. Duration is your sensitivity to a 1 percentage point move in interest rates across the whole curve. So if the yield curve shifts up by 1%, duration tells you how much your bond portfolio is likely to move down. Because don't forget, rates up, prices down, the inverse price-yield relationship. And the general idea is high duration portfolios have a high sensitivity to a unit change in interest rates. So they'll move a lot when interest rates move up across the curve. What we're going to be doing is using these bond futures to change our exposure to duration, either to hedge or to increase it when we're comfortable increasing it. Hedging, of course, is removing it. So we're not going to get too forensic at level 3, but we are going to need to address one technicality about this contract. Being futures, before we do that, let's just talk about some general facts. Being futures, they are exchange traded, so there's likely to be good liquidity in these contracts because all investors are funneled through a small amount of maturities, and the contracts are standardized, so everybody trades the same thing. The types of exchanges that are out there, not usually a focus for the exam, I have to say, but the exchanges that are out there that list futures on Treasury bonds. In the States, you've got CME, you've got options on the CBOE, Chicago Board of Options Exchange. In Europe, you've got Eurex, and in the UK, you've got ICE Futures Europe. So these are the sorts of exchanges where you'll find Treasury bond futures contracts. So we're going to just address a technicality of a Treasury bond futures contract, which we did meet at level 2, but we're just going to meet it in general at level 3. A technicality as to how this contract settles, how it goes to delivery. First up, most contracts don't go to delivery, to the maturity. Most investors don't hold their futures position open all the way to delivery. Most futures investors close out their contract prior to delivery, either because they don't want the exposure through the futures contract anymore, or because they're rolling their exposure into a longer dated contract. So they close out the near dated contract and open a longer dated position. So usually futures positions are closed out prior to settlement. So this technical point we're about to make is usually not relevant for most investors. However, for the investors that do hold on to the contract and go to delivery, in other words, go all the way to the maturity of the contract, keeping the position open, this is the futures position, then the delivery mechanism has a technical point about it that we're going to address here. First up, these futures contracts are physically delivered. That means the short of the contract has to actually deliver an underlying bond to the long. The short does have choices. They can choose which bond to deliver to the long side. Okay, so there is a basket of deliverable bonds that are specified by the exchange that has listed the contract that the short, the seller of the future, can choose from when they go to delivery and they say, okay, I'm now going to deliver a bond to the long and receive some money in exchange for delivering out that bond. That's their obligation under the short contract, to deliver out the underlying and receive cash in exchange. Now, for example, for US Treasury bonds, the short can select these from a basket of deliverable bonds that actually exist at maturity, will exist at maturity, specified by the exchange. They can select, the short can decide which one to deliver. And in the US, these bonds will typically have maturity. These bonds will typically have maturity of 15 to 25 years when we get to delivery of the futures contract. Now, the key thing to appreciate here is that the Treasury futures contract itself is not based specifically on any one of these deliverable bonds. It's actually based on a notional bond that doesn't exist. The Treasury bond futures contract is based on a notional bond. In the US, it's a 6% coupon bond at delivery with 20 years to maturity at delivery. That's what the Treasury futures contract is based upon, a notional bond that doesn't necessarily exist. What we know is that the short will deliver one of these deliverable bonds at maturity of the contract, of the futures contract, and they're very similar. They're going to be very similar to the notional bond which underlies the contract. So these actual bonds that actually exist, you can see their maturity is between 15 and 25 years. So that's close to the 20-year maturity of the notional bond. They're going to have coupons that are going to be different to 6% though. That's going to be another difference between the actual bonds and that are deliverable and the notional bond that underlies the contract. So when the short thinks, they ask themselves the question, which bond shall I actually deliver? When the short of the contract decides to buy one of these deliverable bonds and essentially deliver it out under their short futures position, they're going to think, okay, which bond is going to be the best one for me to purchase and then deliver out under the futures contract. They're always going to do what's best for them. Now, this whole idea that there is a basket of deliverable bonds underlying the contract, essentially, gives rise to this idea of a conversion factor, which is specified by the exchange that is listing the futures contract. So in short, this conversion factor will reflect how valuable an actual deliverable bond is versus the notional bond that underlies the contract. So, okay, in essence, the conversion factor will be above 1 if the deliverable bond, that's the bond that can actually be delivered, is more valuable than the notional bond. Don't forget the notional bond is the 6% 20-year. Okay, and similarly, the conversion factor, vice versa, the conversion factor will be below 1 if the deliverable bond is more valuable. The conversion factor will be below 1 if the deliverable bond, the actual deliverable bond, is less valuable than the notional bond underlying the contract. You might be wondering, why do we do it this way? We do it this way because the exchange doesn't want to put too much pressure on one single Treasury instrument. They don't want to put too much pressure on it as being the only deliverable bond underlying the contract. So that's why they specify a basket of deliverable bonds, which the short can choose from. And the conversion factor, certainly at the start of the futures contract's life, the conversion factor plays the role of trying to make the bonds equally attractive to the short when they think about which one they would buy in order to deliver out under their short position in the futures contract. That's the role the conversion factor is trying to play. It's trying to make all of the bonds equally attractive to the short when the short thinks about which bond they're going to select to deliver to the long under the futures contract. Because this conversion factor, as we're going to see, is going to adjust the amount that's paid by the long of the contract, that's the futures contract, to the short of the futures contract on delivery. I think it's naturally intuitive that if the short chooses to deliver a more valuable bond, then the long should pay more for that. The conversion factor is greater than 1. When I say more valuable there, I mean more valuable than the notional 6% bond that underlies the contract. So, key takeaway here is that all of these deliverable bonds will have a conversion factor. If the conversion factor is high, then the actual deliverable bond is expensive or valuable versus the notional 6% bond underlying the contract. And if the conversion factor is low, then the actual bond is not expensive. You know, it's cheap relative to the 6% bond that underlies the contract. So the reason that we're considering this conversion factor here is because it will affect the duration of the futures contract. It will affect the sensitivity of the futures contract to changes in interest rates. Okay, that's why we're considering it here. And you might have noticed that I've been saying, you know, the conversion factor tries to make the bonds equally attractive to deliver from the short's perspective. So, for example, the short would look at the basket of deliverable bonds, have a choice of 3, 5, 6 maybe bonds, and think, well, because of the conversion factor, each one of them is, you know, equally attractive when I think about which one I'm going to deliver. However, the way this conversion factor is set is not perfect. It does assume that interest rates essentially are 6% across the whole curve when they're thinking about how valuable the underlying actual deliverable bond is versus the notional bond, the 6% bond. And that's not necessarily true. In all, you know, yield curves are not necessarily flat. Plus, conversion factors stay the same over the life of a Treasury future, whereas yield curves do not. So the term structure of yields being different to being flat, and the fact that it changes over the life of the futures contract, means that these conversion factors do not perfectly do the job of making each bond equally attractive to deliver from the short's perspective. What it means is that the short will find that one of the actual bonds, the deliverable bonds, will be more attractive than others when they think about which one they should buy and then deliver out under their short position under the futures contract in order to fulfill their obligation at delivery. There will be one bond out the basket of deliverable bonds which will be cheapest to deliver. Okay? This idea of cheapest to deliver, you have to get inside the mindset of the short of the futures contract. They have to deliver out one of the physical bonds that actually exists to the long side of the futures contract to fulfill their obligation at delivery. And they're thinking, well, what am I going to do? I'm going to buy one of the bonds and then I'm going to deliver it out and receive in the cash that I get under my futures position. Because don't forget, the short delivers out a bond and receives in cash. The short is always going to purchase the bond that gives the best result for them. In other words, the one that's cheapest to purchase in the cash market and then deliver out under the futures contract and receive in a cash amount under the futures contract. So there's a very simplified example, very kind of simplified and straightforward example in the curriculum of what's going through the short's head when they're deciding which bond is the cheapest to deliver. And it captures the whole process perfectly. So let's have a look at that now. Now, two very simplifying assumptions here that are being made. First up, we're going to delivery of the futures contract. Don't forget, the short side can decide which bond to deliver. They're going to deliver out a bond. They can choose which one they decide to deliver, okay? And what they'll receive in from the long futures side, what they'll receive in is some cash. That's what we're talking about here. This is the calculation that we're doing. And that cash will obviously depend on what the futures price is. The short is going to go out and buy the bond, this bond that they're delivering. They're going to go out and purchase the bond. All right. This amount that they actually receive in under the futures contract, okay, this is what we're going to be focusing on now. This is what's referred to as the invoice amount. One of the key simplifying assumptions that we're making here is that the short is buying this bond that they intend to deliver under the futures position. They're buying it at delivery. They're not buying it prior to delivery, which could happen, but it's a simplifying assumption in this analysis that this is all happening at delivery. All right, so the short position of the futures contract is deciding which bond to buy at its current price such that they can deliver the bond out under the futures position and receiving what's called the invoice amount from the long side. And really the short is going to choose the bond that gives them the best result here, the lowest loss or the biggest gain, by going out and buying a bond in the cash market and delivering it under the futures obligation and receiving in an invoice amount that is paid by the long to the short at delivery of the futures contract. So this is crucial, and it's this invoice amount that we're looking at here, and it's this invoice amount which is adjusted for the conversion factor of the bond that's actually delivered. Let's have a look at that. Let's have a look at what this invoice amount actually is. This invoice amount, which is adjusted for the conversion factor of the bond that's being delivered, if we go back to, here, this invoice amount, it depends on the final price of the futures contract. So we've got here this idea that there's a settlement price for the futures contract. This is the final price of the futures contract at delivery. So what the long pays to the short depends on what the final price of the futures contract is at delivery. All right, we're going to look at that price. We're going to assume it's quoted like all bond prices are quoted as a percent of par or par of $100. And what the long actually pays to the short, this invoice amount that's paid by the long to the short of the futures contract, is going to depend on that final price of the futures settlement price. We're going to scale it down by that $100 a par, and then we're going to scale it up by the size of one contract. So it's probably not testable in the exam. They'll give you contract specifications in the exam. It's not that type of exam that they'll expect you to know massive amounts of futures specifications. All right? They'll give you the size of a futures contract in the exam if you need it, but the default in the States tends to be that one futures contract represents $100,000 of par. And that's what that number there represents. The fact that one contract represents the obligation by the short to deliver $100,000 of par. And there is the crucial thing. This conversion factor adjusts what the long has to pay to the short. As we introduced it on the previous slide, the conversion factor of the deliverable bond affects how much the short actually receives. And once again, I'll just reinforce, high conversion factor means the deliverable bond that actually exists is rich and expensive versus the notional bond, which underlies the 6%, 20-year notional bond, which underlies the futures contract. So this is the amount, this is the invoice price that the long pays to the short. That's this bit here. Oh, by the way, if there's any accrued interest on the bond at this stage, that would be added on. All right, so just as a reminder, accrued interest is added on to the clean price of a bond, which ignores accrued interest. It basically increases what the buyer of a bond needs to pay when they buy a bond part the way through a coupon period. The reason they have to pay more is because some of the coupon that they're getting at the end of this period is not theirs. It should be to the short. It's accrued to the seller of the bond because we're part the way through a period. Now, this isn't a technical exercise. If there were any accrued interest, you'd just add it on here. But what I would say is in the example that they give in the curriculum, they just assume that accrued interest is zero. It's a simplifying assumption, and it's nice for us because it means we don't have to worry about adding it on. So yes, you would add on accrued interest here, but in the underlying curriculum, they assume it to be zero, which I think it gives you a good indication of what an exam standard question might do. So we know what the invoice amount is. What is the bond price? What is the short futures position? What are they going to have to pay for the bond that they're delivering out under their short futures obligation? Well, they're going to have to pay the clean price of the bond plus any accrued interest. Now, assuming that they buy the cheapest to deliver bond, assuming that they buy the bond that is cheapest for them to buy and deliver out under the futures position, they will be paying the CTD clean price plus any accrued on the underlying bond. So this, for $100 a par, this sets the short futures positions P&L at delivery if they buy the bond at delivery to fulfill their obligation under the short futures position. They're going to receive in this settlement price times the conversion factor plus any accrued interest. So that's what they're going to receive in. It's essentially a simplification of the total invoice amount for $100 a par. And then they're going to have to take off of that what they paid for the bond that they bought. All right, and they're going to pick the bond that gives the highest profit or the lowest loss, and that will be the cheapest to deliver bond. Okay, so the calculations here, once we get to them, are very straightforward. Have a look at this. There are two potentially deliverable bonds here, or two deliverable bonds, and the short can choose which one they want to deliver. There's bond number 1 and bond number 2. Okay, they've got slightly different coupons and slightly different time to maturity at delivery of the contract, and therefore they've got slightly different prices as well. Now, like I say, accrued is always assumed in this example. When you look at the curriculum, they assume accrued to be 0, because that's really not really the point of this exercise. The point of this exercise is to identify which bond gives the most profit or the least loss if we buy it today and then deliver it out and receive in the settlement price of the future adjusted for the conversion factor. So it really becomes an exercise in simply saying for each bond, okay, if I receive in essentially conversion factor adjusted settlement price for each bond, and I have to pay out the bond when the bond's price when I buy it to get it in so I can deliver it out under the futures position, which one gives me the biggest profit or the lowest loss when I do that. So as you can see, what's coming in I've made orange, what's going out I've made blue. And you just tally up essentially these two numbers. And what I mean by that is the orange stuff, which is coming in under the contract. You know what that is. That's the settlement price multiplied by the conversion factor. We can quickly calculate that for both bonds. All right. Bond 1, 148.75 times the conversion factor of the bond. All right, 148.75 is the settlement price. 0.9422 is the conversion factor of that bond. And then for bond 2, it's similar. 148.75 is still the settlement price of the futures contract, but that bond has a slightly different conversion factor, 0.9719. Now, the total invoice amount is given by multiplying those two together. That's how we get these numbers here. All right, and that's the kind of the net orange amount that's coming in. We are assuming that, of course, that accrued interest is 0. So how much will we pay out for these bonds? Well, you just pay out their price. All right, their dirty price. We're assuming once again that accrued interest is 0, but that's what you pay out for bond 1, and that's what you pay out for bond 2. All of this is done for $100 of par. So all you need to do is look at the difference between the orange coming in and the blue going out. That would be your loss, 98 cents if you bought bond 1 at 141.13 and delivered it out and received in 140.15. You have a loss of 0.98. Similarly for bond 2, if you bought it for 145.10, you delivered it out for 144.57, that's a loss of 0.53. So the point of this analysis is you'd rather have this smaller loss when, as a short position in the futures contract, you're deciding which bond to buy for the blue amount and deliver out and receive in the orange amount under the futures position. You'd rather suffer the smaller loss. So bond number 2 is the cheapest to deliver bond here. All right, so that's a basic little example, and the point of that is to assess which bond is the cheapest to deliver bond. From here on in, we're always going to assume that you just know what the cheapest to deliver bond is. And markets generally do. They can always do a little calculation like this, even prior to delivery, and they can think about what the cheapest to deliver bond is. It is a quantitative mathematical calculation, and if you called the Treasury futures contract up on your Bloomberg screen, it will tell you what currently, given market conditions, what the cheapest to deliver bond is. What would give you the best result if you bought the bond today and sold the futures right now and then held the bond to delivery and delivered out under the futures contract. You can always identify the cheapest to deliver bond. Now, this is important for us because it affects the price of the futures contract. The fact that the cheapest to deliver bonds conversion factor affects the invoice amount, as you can see here with the orange numbers. It also, that means it's going to affect the price of the futures contract itself. Okay, we're not going to price futures contracts here, but it might be worth just reviewing in very, very basic terms. All right, these are kind of hits that we took at level 2, but it might be worth reviewing in very basic terms how the conversion factor does affect the quoted price of the futures contract. So it's very basic futures pricing actually. When you think about looking at a futures contract that goes to delivery here, and there's a, if you like, a spot bond price today that you can buy the bond for. I'll just call that B0. You can buy the bond for B0 today. We'll assume that's a dirty price, so effectively, you know, accrued interest is captured there. You know that the cost of you buying that bond today and carrying it to delivery, well, that's just the future value of B0. B0 is just a bond's price today, the underlying cheapest to deliver bond. We'll assume that we're looking at the cheapest to deliver bond from here on in. So what it costs you to buy the cheapest to deliver bond and carrying it to delivery today is just the future value of the price, the spot price of the cheapest to deliver bond. So what are we going to receive in at delivery to help, to offset this cost that has rolled up into a future value? We know that under a short futures position at delivery, what we'll receive in is the futures price, okay, multiplied by the conversion factor, essentially. Okay, that's, you know, that's the essence of it. I am simplifying it in great detail. I'm going to ignore accrued interest again, but the point here is this: when we strip out what the fair futures price is today, we can just use this little equality here. The fair futures price is one that sets futures times conversion factor equal to the future value of the bond. In other words, the future value of all our costs of buying and holding the bond. Okay, so the fair futures price comes from this little relationship, and that is the fair quoted futures price today is times the conversion factor must be equal to the future value of the cheapest to deliver bond. Don't forget that is the cheapest to deliver bond. All right, so let's just call that the CTD there. So we know that the futures price F must be related to the future value of the cheapest to deliver bond divided by the conversion factor of the bond. I'm just rearranging that equation to isolate what the fair futures price is today. Now, all of that is a bit of an aside, but the point that I'm trying to make here is that when you move from the CTD bond to get to how the futures contract is behaving, you would divide down by the conversion factor. That's what comes out. That's the key takeaway from this analysis. Okay, and we did this at level 2. When you're looking at a futures price and you're starting from the CTD, you divide down by the conversion factor to get back to what the futures price is actually doing, what the fair futures price is, all right, and therefore how it tends to behave. Now, what that means, of course, is that if you are holding the CTD, the conversion factor is going to play a key role when you're thinking about how many futures contracts you need to hedge your holding of the cheapest to deliver bond. Okay, so the crucial takeaway from this analysis, this aside, if you like, is that changes in futures prices are going to be related to changes in the CTD. I'll drop the terminology here, but changes in the underlying CTD relative divided by the conversion factor. That's a crucial relationship that you're going to need to take in to your exam, with you, okay? Because we're going to use this when we're thinking about the number of futures contracts that we need to maybe hedge duration, remove duration, we're going to need to know how our futures contracts behave. And if the examiner gives you information starting with the CTD, you're going to need to know that you divide through by the conversion factor to get back to how the futures contract is behaving. Okay, so this is a crucial relationship we're going to come back to. So yes, we know that we can use these treasury futures to hedge duration or to alter a duration of a portfolio. So we know that much. And generally speaking, if you sell futures, you will lower the portfolio duration. All right, just like if you sell bonds, you'll lower duration. If you sell futures, you have to deliver out bonds, that lowers duration. If you buy futures or go long futures, that increases duration. So all of that is intuitively in line with our understanding about buying and selling bonds. The question becomes, we already know how the futures contract is likely to behave or does behave relative to the CTD, how it should behave relative to the CTD. That's what we just did in the aside of slide. Changes in the futures contract are related to the CTD by dividing through by the conversion factor. The question becomes, how many futures contracts would we need to fully hedge a portfolio of bonds? Well, the answer to that is very straightforward. How many contracts, how many treasury contracts would we need to fully hedge a portfolio of bonds? I think the answer to that is relatively straightforward. If we've got a portfolio P, we'd want the change in that portfolio to be exactly offset by changes in the futures price, multiplied by the number of futures contracts. That's a very simple relationship. Obviously, we're going to take an opposite position in our futures contracts as we do. Usually we're long bonds, so we'd sell futures contracts. But this is a very basic relationship. Now, the reading calls the number of contracts the hedge ratio, abbreviated to HR, all right, hedge ratio. But that's it, that's the essence of this. The number of contracts we're going to need to hedge our exposure to duration is really thinking, well, let's have a look at the change in our portfolio relative to interest rates, and we're going to essentially invest in the number of contracts, which means that change in the futures contract times that number of contracts exactly offsets the change in our portfolio. Of course, we already know that delta F can be expressed as delta CTD divided by the conversion factor. Okay, so that is a key relationship. We did that off slide. So that's where this little relationship is coming from. To get the number of futures, this hedge ratio, number of futures contracts, we want that number of contracts to scale up a change in futures price and offset the change in the portfolio. We know from our side that change in futures is essentially given by change in CTD divided by the conversion factor. If I rearrange this equation, let's just write this again. If you're looking for the hedge ratio, so change in the portfolio, we can write it as hedge ratio times CTD, change in CTD over conversion factor. If you're looking for the hedge ratio, then actually the hedge ratio comes out as change in your portfolio relative to change in the CTD multiplied by the conversion factor. And that's a very useful kind of version of this formula. The number of contracts you need to hedge your exposure to duration fully, you would obviously go the opposite direction to your portfolio exposure, is change in your portfolio, or if you like, sensitivity of your portfolio to a change in interest rates divided by sensitivity of CTD to change in interest rates multiplied by the conversion factor. So this little equation here, it's very simplistic, very easy to use, but it does assume that your portfolio, that you are fully hedging, all right, and it does assume that your portfolio is behaving very much like the CTD. A more general idea would be to hedge a portfolio that isn't necessarily the cheapest to deliver bond, or to adjust our duration to something other than zero. So there is a more general relationship which is coming up, and probably a more useful relationship as well. All right. Okay, so we've seen there a very simplistic relationship between a portfolio that we're trying to hedge and the futures contract, which gives us a number of contracts to use to hedge. But things aren't always that simple. Extra complications are going to arise when we're not fully hedging So we're not targeting a duration of 0. And particularly when the portfolio that we're trying to hedge is not a portfolio of CTD bonds. When either of these two things are the case, we need a more general expression that's just a little bit more sophisticated and a little bit more flexible. Okay? Now what we're talking about here when we're hedging a portfolio that isn't the CTD bond, a portfolio of bonds that don't necessarily underlie the contracts, they can behave similarly but not exactly the same. What we're talking about here is basis risk. Basis risk always occurs when there is some sort of difference between the derivative that we're using to hedge and the thing that we're trying to hedge. Okay? Now basis risk can be dealt with by being a bit more sophisticated in our calculation of the hedge ratio. All right? We're going to use something here called the duration-based hedge ratio, which is actually based on basis point value. Basis point value, you might remember, is the dollar exposure. In words, it's the dollar exposure that you have to a 1 basis point move in interest rates across the yield curve. Basis point value it's a dollar amount, and it's calculated as the modified duration of your portfolio multiplied by 1 basis point. Now in decimal terms, 1 basis point is 0.0001. The way I like to remember this is it's 1/100th of a percent. So to get to the decimalized version of 1/100th of a percent, what you've got to do is multiply by 1 over 100 to decimalize a percentage, and then multiply by 1 over 100 again to get to 0.01%. In other words, it's the inverse of 100 squared. Right? That's, divide by 100 to get to a decimal, divide by 100 because it's 100th of a percent. That's the easy way to remember it. And then we're going to multiply through by the value of the portfolio. All right? This is something that's very important for your exam. Make sure you can quickly strip out of a question a basis point value. It might be that they don't give you it explicitly. You're expected to strip it out of a situation, as we're about to see. And the idea is this: the number of contracts that you need to get some sort of basis point value target in your portfolio relative to what your basis point value is right now in your portfolio, or to get that change in basis point value, you just need to divide that change by the basis point value of a futures contract. And that's your hedge ratio in its most simplistic form. Makes sense, doesn't it? If you want to change your basis point value by, say, $5,000, and each futures contract brings with it a basis point value of, say, $1,000, well, you're going to need 5 contracts. So essentially here, I'm going to introduce the other thing that we spoke about earlier before as well, and that is, don't forget, a futures contract is related to the CTD by dividing through by the conversion factor. That's something that we emphasized earlier on. So you could always replace on the denominator here, if I rewrite this, the numerator will stay the same. Now on the bottom I could put BPV CTD divide by conversion factor, but actually if I divide by the conversion factor on the bottom, I can just say, look, dividing by something on the denominator is the same as multiplying through by it. Okay, so that's why the conversion factor, instead of dividing through twice, we just multiply through by it. If you divide by half, it's the same as multiplying by 2, isn't it? It's that kind of basic algebraic relationship. And this is a really, really crucial formula. This is like one of the most important formulae of your exam. It's got an equity flavour as well, and as we'll see later on in this reading, it's got an equity version of it. But this is really, really crucial. Okay, everything on the slide there is defined as per we've defined it off slide. Don't forget that one contract has a par size of $100,000. I'd expect you to be told that in a question, but in the unlikely event that you're not told, assume $100,000 for a contract size. So the market value of the, when you're thinking about the market value of the CTD bond that underlies one contract, you can take the CTD price for $100 a par, divide by 100 to get to $1 of par, and then scale up by the size of one contract. So technically that is the market value of the CTD. All right. So let's use it. Classic level 3, it's not really deriving the theory anymore, it's more about application. Here we've got a fixed income manager with a £60 million portfolio, wants to fully hedge against parallel movements in the yield curve. A full hedge would be a target BPV of 0, wouldn't it? The current portfolio modified duration is 10.75. They're going to sell to a lower duration, remove it, UK government long gilt futures. Now, the name long gilt here just means the asset underlying the futures is a long-dated UK Treasury bond. In the UK, Treasury bonds are called gilts. Okay, so let's compute the hedge ratio, or the number of futures, to immunise the portfolio, to fully hedge. Let's also mix it up and target a different duration, which is what this more sophisticated measure allows us to do. Let's target a duration of 8.7, see how many contracts we need to attain that. So here's some details about the contract. There's the futures price, the futures contract size we're given. CTD, we're told some details which aren't massively relevant, but that is, CTD price is relevant, and the CTD conversion factor is relevant as well. Okay, so we're going to, and the CTD modified duration, all of these things are going to be very relevant when we're calculating our hedge ratio. So to start off, to immunise the portfolio, this means that our basis point value target is going to be 0. That's trivial. All right. The current basis point value of the portfolio is its modified duration, 10.75, multiplied by 1 basis point, which in decimal terms is 0.0001. Okay. And then we multiply through by the value of the portfolio. All right, so go back and have a look at the previous slide. You'll see that the manager's currently sitting on a $60 million portfolio with a duration of 10.75. That's where those numbers are coming from. And that gives us a basis point value right now of 64,500. You're then going to calculate the basis point value of the CTD. So you might remember the modified duration of the CTD is 9.7. 1 basis point, once again, is 0.0001. And just be careful with the market value of the CTD. All right, you know, that price is for $100 of par, so divide through by 100 to get $1 of par's value, and then scale up by the size of the contract. And you come out with a relatively low number here, because this number really only represents about £139,000 worth of exposure, not the $60 million of exposure that the manager actually has. But if you take the target of 0, you see how far away that is from the current BPV, you divide through by the BPV of the CTD, and then you scale up by the conversion factor. Don't forget that conversion factor needs to be bolted on the end there. Then you get a number of minus 510.24. All right, so always round to the nearest number, because with futures, they're exchange traded, you can't trade a fraction of a contract. Okay, so always round to the nearest whole number. Not up always, not down always, just to the nearest whole number to give you the most accurate hedge. Okay, so that's targeting a duration of 0 or a BPV of 0. What about the other scenario where we're targeting a duration of 8.7? Well, the only thing that changes here is our BPV target is not 0 anymore. It's not trivially 0. It's set by the fact that we want a $60 million portfolio to have a duration of 8.7. So when we calculate the BPV in a way exactly analogous to before, we get a target BPV of 52,200. So that target goes in here. We take off where we currently are, divide through by the BPV of the CTD, multiply through by the conversion factor, and we get minus 97.30. So once again, round to the whole, the nearest whole number, we're going to sell 97 contracts to target a duration of 8.7.